good afternoon. You're watching ET Now. I'm Anisha Jain. With me is Aisha Faridi. And for now, the markets have fizzled out completely. And I say that because 17,600 was comfortably held throughout the trading session. But now we are just inching towards the 17,600 mark. And the underperformance clearly today is the Bank Nifty. Let's pull up the intraday chart of Bank Nifty actually. And that will tell you the kind of weakness that is there. That index is down over 200 points in the trading session. And look at the slide in the last few minutes itself. In fact, that particular index is almost 300 or 400 points off the highest point of the trading session. So that remains the key talking point. But apart from that, overall the year has started on a decent note. Over the last 2 weeks, Nifty has managed to gain around 800 points. So maybe a bit of sideways moves for the timing is what we are seeing. Though can't say the same about realty space because that one is on a tear. Last week we had seen a stellar rally of around 4 to 5% on that one, and today itself that index is up around 4%, and all the names like Prestige, DLF as well as Godrej Properties are up anywhere between 5 to 10%. Autos too are on the front foot today. Tata Motors is of course the leader of the pack with a gain of almost 6%. But then you also have industrials, L&T sitting at a record high level. Siemens is also doing quite well in the trading session, so a bit of a broad-based move.
Yeah, a bit of a broad-based move, and of course, you know, the big stunner today has been the realty pack first of all. But before that, Tata Motors, that's what our day began with. That huge gap up on Tata Motors managed to sustain large part of its gains. The stock is still higher by 5.5%, and JLR sales have risen in the fourth quarter as the chip supply continues to recover and rebound. Free cash flows are expected to be about almost 800 million pounds. That's Tata Motors in trade for you, holding up 5.25% as we speak. In fact, brokerages as well pretty bullish now on Tata Motors, and a couple of these upgrades coming in, which is clearly aiding to that buoyancy on the stock. Goldman has put a buy with a target of 550. Bank of America as well, a buy target, or rather buy call with a target of 475. Real estate, that's the one sector which is holding out well, while banks are dragging clearly on the other. So everything from an Ajbera to a Godrej to a Sobha, they've all come out with extremely strong Q4 commentary as part of their updates. So that's pretty much been the case for both Sobha as well as Godrej. They are the ones which are holding out very well, as is Credit Access Grasim. Again, strong Q4 update, growth momentum in value as well as volume term clearly continues. AUMs have seen an uptick of 27% on year-on-year basis, which is higher than what some of the brokerages were anticipating, and that's the stock, although it's cooled off quite considerably from the session highs, but still managing to cling on to the grains. But let's try and understand as to why this sudden fall in the market. Kunal and Naresh on the show as always. Kunal, what explains this sudden drop?
Well, I think the last I could see was from the data from the options pack, because throughout the day there were three different stances of option traders. So in the first half an hour or so, when the markets opened up and settled out into a trading or flattish kind of a trading range, the skew was more towards shorting of the 41,000 call option. So, you know, between the 41,000 call and the 41,000 puts, the call writers were more often going into an upper hand. And in between, in just around the noon time is where the put writers started to get into a stronger breakout mode. But then I think the stance changed back again. So I think it's more of a shuffling of options positions, which I could gather in terms of the data, which has led to the intraday drop on the indices. The other way to look out for is that 17,700 mark has been tested now twice in the last two trading sessions, and there has been some supply which has come back into the indices at those levels, which means that there could be a stronger chance that the markets may get into a bit of a profit booking mode from here on. So I think what we've seen right now may probably be a start of the next couple of days of mild bit of profit booking, where 17,700 on the Nifty can remain a resistance, and possibly 41,000 on the Bank Nifty could remain a resistance. So keeping both of these resistances at play, we might see some bit of more tapering off on the indices.
Okay, so a bit of profit booking is what Kunal is sensing on the charts. But Naresh, what about you? What kind of trade would you, recommend at this point of time at index level, whether Nifty or Bank Nifty?
So as of now, I would expect a couple of days, or at least 2-3 days of consolidation. As closer to 17,500, 550 spot levels is where I would like to buy Nifty for an intraday trade. As of now, we are still stuck at 17,600. Overall, on the upper end, 17,800 is the next resistance. So expecting some bit of a pause, expecting more stock-specific action. We are seeing mid-caps and small-caps seeing some breakouts in particular stocks. PSU names are looking good. So time to be more stock-specific. Wait for some time for the index to consolidate at least a few sessions.
So consolidation, that's the name of the game, at least for the moment. But then, as I pointed out, the year or the financial year beginning has been quite decent for the Indian markets. Shubhani Sarkar Korean also joins us on the show. Shubhani, hi, thank you so much for making time and speaking with us. Your take on the market, it was looking like we are getting out of the range now. The earnings season is just, starting with in a couple of days with TCS itself. What's your sense of where the markets will be, let's say, in the next 2 to 3 months? Any sense?
Yeah, hi, good afternoon. So our belief has been that markets will likely remain volatile at least in the near term, with range-bound movement in the market. Now, globally, what clearly market is looking at is the inflation trajectory, and for our domestic markets, the key factor that will drive market performance will be the earnings season and the earnings trajectory. Now, when you look at Indian markets from a valuation perspective, Indian markets have clearly corrected, and that has resulted in valuations on an absolute basis moving back to long-term average multiples. And even relative valuations of India relative to the emerging market pack has now come down closer to the long-term average level. So valuations have become far more attractive. However, they are not still in a range, which means that markets will see significant up move. And given the fact that globally macro uncertainties remain, we do believe that markets will see some degree of volatility in the near term. Now, in terms of earnings, what we believe is that in this quarter and for the year as a whole, which is FY24, you will see dispersion in terms of earnings at a sector level as well as at a stock level. So FY24 will continue to be a year where you have to be pretty much stock specific in nature, focus on companies where there is earnings visibility and where valuations are on your side. Overall, the way we look at markets and sectors, the domestic facing companies and sectors continue to be better placed. So banks, industrials, automobiles, cement, these are some of the segments where we continue to remain positive as compared to the global cyclicals.
Talking point, of course, is going to be the IT numbers, which are going to start trickling in. Anisha, what's the large anticipated, considering traditionally Q4 is a muted quarter?
That's exactly what Street is expecting. Seasonally weak, plus the fact that the growth rates are expected to taper. That's going to be the color of IT earnings in the quarter gone by. And when you look at the constant currency growth, it's expected to be largely flat. There are a couple of companies, the likes of HCL as well as Tech Mahindra, which are likely to actually report a decline on a sequential basis. But other than that, TCS is the one which will start the earnings season and perhaps would be the leader of the pack when it comes to the revenue growth as well. The margin estimates are actually a tad bit better. Largely, the Street is expecting a 20 to 50 basis point improvement across the board for all the companies on a sequential basis. FY24 guidance will be key to watch, and that's why Street is expecting for Infosys. Of course, the double-digit growth is out of the way, so they're expecting that perhaps the growth of 5 to 8% is what they'll pencil in, and the margin of 21 to 23% for Infosys in FY24. For HCL Tech, the growth could be 6 to 8% in constant currency in FY24, and the EBIT margin will likely be in the 18 to 20% range. And Wipro specifically for Q1 FY24 might guide for a decline of 1% to a growth of 1% kind of range. So we'll watch out for that. Just that in terms of the valuations, they have become a lot more comfortable. So if you compare the 5-year averages for the likes of TCS and Infosys, the stocks currently are trading below that mark. So there is that bit of upside available. And that's why perhaps these stocks are going a little bit stronger into the earnings. IT sector today holding up with a gain of around 1.5%. But IT is no comparison to the kind of gains that we are seeing in the realty sector today. That's up almost 4%, and the commentary, of course, across the board has been quite solid. Let's go across to Vamakshi to understand how does the sector dynamic pan out at this point of time. Vamakshi, take it away.
Well, absolutely. It has turned out to be a record year for real estate players. Let's first start off with Macrotech developers. Now, the company has reported pre-sales in FY23, and in fact, they've surpassed their guidance of around 11,500 crores. In fact, it also happens to be the third consecutive quarter where the company has clocked in pre-sales of over 3,000 crores. Now, as far as Godrej Properties is concerned, their annual booking is nearly 22% ahead of their full year guidance. In fact, they're targeting pre-sales of nearly 20,000 crores by FY26. As far as Sobha is concerned, they forayed into the Hyderabad real estate market in the fourth quarter, and in the fourth quarter itself, their average price realization has also seen an improvement of nearly 20% year on year. Ajmera Realty is also in focus as the company has aims to double its launch pipeline in FY24 given the good momentum that they're seeing in sales, and in fact they're targeting 2,000 crores of gross sales. So overall a strong operational update so far, but it is also interesting to note that developers have managed to sustain pre-sales in the last 6 6 quarters. Now, as per a recent report by Avendus Spark, aggregate pre-sales have reached between 10,000 to around 12,000 crores for companies within their coverage. But at the same time, in the last 6 months, realty stocks have definitely taken a beating, with stocks such as Sobha as well as India Bulls declining by over 20%. Other counters like Phoenix Mills, Macrotech Developers as well as Prestige Real Estate is also seen under pressure. Apart from that, this fall has, when we look at it, this fall has in turn led to valuations falling below or staying at par with the 2-year average. But going ahead, we're seeing a lot of tailwinds for the sector. Repo rate has remained unchanged, which is a welcome respite to home buyers. Q1 2023 end housing inventory is down to 20 months from 42 months that was seen in 2018 as per ANROC, and this in fact is the lowest inventory overhang in the last 5 years. Luxury home sales are also seen boosting revenue, and this segment particularly is seen performing well as well. Apart from that, rising rentals are also expected to incentivize home purchases. So going ahead, the going seems really strong for most real estate players.
Going keeps us strong, or rather seems strong, and the stocks as well are going good in today's trading session. I mean, be it a DLF, be it a Godrej Properties, be it a Sobha, the entire pack is holding a buzz. Godrej Realty is also seeing a decent move in trade, holding up 1.25% right now. Shivani, just wanted to get your sense in this high inflationary environment. What's the take that you have on realty and how the sector should be looked at?
Yeah, so real estate is a sector where we have been positive on, and what we've seen over the last couple of years is that with improvement in terms of affordability, demand momentum has sustained, and that's showing through in terms of numbers. Specifically, the premium segment has seen improvement in terms of demand. Overall, as you were just discussing, one key factor that has been positive for the sector has been the decline in terms of inventory, and demand supply dynamics have now moved in terms of a favorable situation. Also, from a policy perspective, what we have seen is that various policy changes has resulted in shift towards of market share towards the larger organized players, and that is also reflected in terms of the listed space in the real estate sector. However, from here on, one key factor that we need to note is that interest rates and home loan rates have gone up quite sharply. Of course, the recent pause is something that is favorable, and we'll have to see how the monetary policy and interest rate environment moves going forward. So that's one thing that we will watch out for in terms of the overall demand in the real estate space. But as of now, given the fact that inventory levels are fairly low, demand supply dynamics are in your favor, and affordability still remains fairly favorable, our view on real estate continues to remain positive. We will also have to take a view on individual stock basis given valuations. However, the overall sector continues to be well placed at this point in time.
Okay, so the sector is well placed, but stock specific speaking, Naresh, would you be a buyer in any of the real estate names?
So would be waiting out for a little bit of a dip, because in the last 2 sessions, a lot of these stocks are up between 8 to 10%. So the risk reward becomes a little difficult, but the price action is very positive across the board. So whether it's a DLF, which looks the most promising one, or something like a Godrej Property, which is bouncing after falling 50-60%. So there are multiple choices here, but I would wait for a little bit of a fade off over the next couple of sessions. Say, for example, a DLF comes down to 390, that would be 390.94. That would be a zone I would be looking to watch out for. 1130 to 1150 for Godrej Properties. So overall, positive on the sector. Expect some bit of a pause, and then it could create an opportunity. If it takes a runaway move from here, would have to let it pass, because the risk reward is not that great at current levels.
Okay, so the risk reward is not that great, but since we're also talking about IT expectations and how that sector is poised, Kunal, your take as far as how one should approach the IT pack ahead of the earnings season? Is there more possibility of buying on news when the earnings surprise, or sell on the rally?
So I would believe that the action would be very, very specific towards certain stocks. So for example, the likes of Infosys has underperformed. KPIT Tech, of course, has been going through a sharp selling in the last 1 or 2 weeks. But then there are many recovery candidates which have done reasonably well. Coforge has done quite well from the mid-cap IT space. Tech Mahindra is holding on to that 1100 mark. TCS has seen a good recovery. So the action is a lot more mixed into the IT pack. So it's going to be very difficult to try and take a sector call basis on the expectation of results going forward, because the way in which stocks are going into the results season is quite divergent from the sector as well as the larger cap peers. I would bet on few large cap names. For example, Tech Mahindra is something which I've been bullish on, and I still believe that 1100 mark, it looks very attractive at the zone. Redington is something which again I've been very bullish on. I think closer to the 200 moving average around this 160 162 mark is where we flagged off a buy on the stock. So we would look to accumulate the stock in case if it dips back to those levels. So few candidates from the IT pack, just based on the individual chart patterns, nothing major or nothing critical happening in terms of the sectors.
One word on each on TCS and Infosys ahead of earnings. Any trade? Buy, sell?
No trade.
No trade whatsoever.
Be safe, no trade. Okay, we're going to take a very quick break. Lots buzzing in the market while the overall index may have quietened down. We'll take a break and continue tracking markets on the other side. Welcome back. You're still with Closing Trades right here in ET Now, and a smidge of a recovery actually from where we flattened out. So we're back at that 17,650 plus levels, but definitely not close to the day's highs. There's Godrej Properties, DLF, PFC, REC, those are the stocks which are holding out, as is Tata Motors and ONGC, which are really aiding up and holding out very well. In fact, on the subject of Tata Motors, as the earnings season kicks off, they've shared their updates for the JLR business. In fact, sales have risen in the fourth quarter on the back of improving semiconductor supply constraints. So let me take it across to Sharad and find out what else they have to entail on with regards to their Q4.
Well, yes, in focus we are having Tata Motors, as an important update has come from JLR, where the sales for the fourth quarter has increased, and this is also coming in as the chip supply has improved and recovered as well. Now looking at the numbers, the retail sales is up 13% on a year-on-year basis, and when it comes to the order book number, that comes in strong at almost 2 lakh units. However, this is 15,000 low as compared to the December quarter. Now of course the free cash flow statement, that is expected to be almost 800 million pounds positive. This is for the fourth quarter, and for the whole entire year itself is expected to be around $500 million. It's kind of a thumbs up coming in from the brokerages, as we expect BofA on Tata Motors. They have given a maintained buy rating with a target price of 475 rupees per share, and they've stated two important things. The first one being, of course, the volume and the free cash flow growth that has been beat, and that has actually beat the overall estimates by the analyst community, and they're expecting that there would be an accelerated deleveraging happening across the board. And apart from this, there's a solid ramp up of the JLR brand expected, and the amount of booking run rate is expected to be better than what the street is estimating. Apart from this, even Goldman Sachs has upgraded the stock to buy from the neutral segment, and the target price is set at 550 rupees per share. And looking at the valuations, the stock is trading at almost 7.4 times its P on its FY25 estimates, and they are expecting that there would be an improved volume outlook going ahead for JLR. And do remember, JLR contributes almost 70% of the total Tata Motors top line. Now looking at the EBITDA numbers, they are expected to be lifted, coming in by almost 15% growth for FY24, and for FY25 is expected to come in more than 16%. And lastly, Goldman Sachs stated that the market is still underestimating JLR's EBIT margin potential going ahead. So overall, we can say a strong thumbs up coming in by the brokerage community.
Okay, so the key takeaway for me was the fact that the cash conversion or generation has been almost twice than what the company had indicated at the start of the quarter itself. And of course, the volume figures are also quite enthusing. And while Goldman Sachs has upgraded Tata Motors, they've actually downgraded Maruti. So is that the trade? Naresh, your take, Maruti is Tata Motors, which is likely to outperform, and what's the trade in the auto sector?
So it could very well be both of them perform, but Maruti is something which I don't expect to underperform in a big way. Technically, the stock has been making a good base around that 8,000 to 8,200 mark. The longer term trend is that the stock has gone nowhere from those highs in 2017-18, where it topped out 9,500, 10,000. Very recently also it came to 9,500 odd levels. In the near term, I expect a move towards 9,000 for the stock. 8,300 would be a stop loss which I would keep. So short-term positive on Maruti, but Tata Motors is a much longer-term breakout in the making because it went through a good enough consolidation of 1.5 years after that big move towards 530. And today's price action is also with good volumes, could certainly be a start of a new trend for the stock, wherein it could slowly and steadily go towards 530 and 650. Now would keep a revised stop loss at 425 and look to buy the dips on Tata Motors.
What do you do with the realty names? Because, DLF has been a favorite, but look at the move that you're seeing on a Godrej today, for instance, or for that matter, the non-F&O names as well. It's pretty much a secular move across the sector.
Yeah, so I think the sector is getting a lot of confidence today with the moves, with the likes of DLF. I think Godrej Properties, Oberoi Realty also did quite well last week. So I think it's more of a sector move which is getting a lot more confident, and that's why you're seeing the non-F&O stocks or the high beta pocket from the high beta sector. High beta stocks within the high beta sector, seeing a lot more price action for themselves. But then, once this phase of initial euphoria sort of settles out, it's the stronger candidates which would tend to outperform. And my bet would still be on the likes of DLF, from current levels, from the F&O listed stocks, on the real estate pack, and Anantraj Industries on the non-F&O stock. I think both of these stocks have shown some very strong classical breakouts for themselves. So most of the other names like Oberoi Realty, Godrej Properties, these stocks are going to a recovery phase, whereas the likes of DLF as well as Anantraj, they've already confirmed breakouts on higher time frame charts. So I think that's where the leadership would probably continue to sustain. So I would be bullish on both of these stocks.
Okay, separately, Shibani, in your opening comments, you talked about how you're positive on the capital goods space, but the likes of L&T as well as Siemens are sitting at record high level as we speak. L&T above the 2300 mark. Is valuation a concern at all, or there are select names which are still attractive?
So we are mindful of valuations in the capital goods space. But however, if you look at as a theme, the entire infrastructure, manufacturing, capital goods theme continues to remain intact. The order momentum that we have seen has been extremely healthy, and we've seen large ticket orders coming through for some specific companies. So overall, we believe that the overall order growth in the next year, led by infrastructure spend, by defense, as well as some of the short cycle industrial orders that we have been seeing in the past, will likely continue. So far, when you look at the entire space, a lot of the growth has been driven by public capex, focusing specifically on roads, railways, and defense. And incrementally, we hope to see that over the next 12 to 18-month period, some signs of private sector capex also coming back. The overall balance sheets of the companies within this space continue to remain strong, and that is something that is a positive. And therefore, this is a theme that we continue to play across our portfolios. We are also seeing investments in new sectors such as renewables, green hydrogen, defense, which is again a large opportunity. And all of this is attracting investments. And therefore, growth is likely to remain fairly strong. Of course, we are mindful of valuations, as you correctly pointed out, but we do believe that the opportunity set remains intact.
Shivani, aside of the sectors that we've talked about, which are the other sectors which you at Kotak are bullish on right now?
Yeah, so some of the sectors that we continue to be positive on, firstly, the financial space. Here we believe that there has been significant improvement in terms of the underlying profitability and return ratios, especially where the larger private sector banks are concerned. However, valuations don't seem to reflect so. And in fact, if you look at for the banking space as a whole, valuations are now below long-term average multiples. Now, there is a lot of debate that is going on in terms of whether margins will start contracting or not. We do believe that there is still some leg up in terms of net interest margins moving up quarter on quarter, though of course the pace of margin improvement will start to slow down. However, despite that, we believe that the sector in terms of earnings remains fairly strong going into FY24. And in this space, we are looking at banks which have a strong retail liability franchise, which will be the key differentiator. So that's one segment where we are positive on. The second space is the auto space. Again, we have seen numbers coming through in terms of growth, both in terms of passenger vehicles, CV, as well as two-wheelers now also at the margin starting to show improvement on growth. With commodity costs having coming down, margins are also likely to show an up move, and therefore this is also a segment where we are positive on. So overall, in the domestic space, financials, industrials, auto, these are some of the segments where, as sectors, we are positive across our portfolios.
Shivani, great to have you on the show. We'll let you go on that note. Thanks as always for joining in.
Thank you so much.
Before we reach the midpoint on the show, let's take in some more fresh strategies then from both Kunal as well as Naresh. Kunal, on your list, closing ideas?
So that will be book profits on DLF from an intraday perspective, something which we initiated at the start of the day. So I think at current levels of 406.7 on the spot levels, I think it's a good zone to book out profits and then look to buy back in case if the stock dips back towards the 395 mark tomorrow.
Right. Naresh, what about your closing trades?
So continue to have the bullish view on Indian hotels. Add on the stock. The stock tried to cross that 330, 32 mark today also. Looking at it as a stock which could get into a new all-time high.
Okay, on that note, we're going to take a very quick break. Still pretty quiet on the index. Still skirting around that 17,675 level. Actually, no, we've picked up a little bit from there. 17,688 now for the Nifty futures, if that's any meaningful. Tata Motors still in pole position along with ONGC. Quick break. Be right back for more.
Welcome back. Well, it's the underperformance of the bank Nifty, which is really, surprising because that index is down a good 200 points, so 0.5% lower on that index, whereas the Nifty is holding up in the green around 0.2% higher. So bit of an underperformance coming in from the bank Nifty, and it's private banks which are taking it on the chin. So ICICI Bank, IDFC First Bank, HDFC Bank, these are your top laggards when it comes to the banking names as well. Having said that, from the broader markets, there's definitely spots of green. Rosari Biotech, for instance, has suddenly spiked as much as 16%. Let's pull up the intraday chart of that one. No specific news flow that we can spot, but nonetheless, that stock has seen the biggest single day gains since September of 2020. So massive surge there. And then Neogen Chemicals, wherein the volume is 8 times the 10-day average. This is an exclusive story that we have been bringing to you as well, wherein Ajay picked up that there's a bit of tie-up with one of the Japanese company for technology, sharing that they are going to announce later today. So we are tracking that. But quickly, Kunal, if you track either of the counters, Rosari Biotech, Neogen Chemicals, and even other chemical names like FACT, etc., which are quite excited, anything that you would suggest on the charts?
So Rosari Biotech, I think, is more of a recovery from the previous 52-week lows. I think the stock had hit lows of 550 in the last 1 or 2 weeks. The stock was going to a recovery, so I think it's more of a recovery for the stock from a longer term charts. For Neogen Chemicals, this could be a breakout because potentially the stock has confirmed a strong price volume up move, breaking past about the 1350, 1375 previous hurdle and then crossing over those levels on the back of some extremely strong volume. So I think both of the charts are completely different. Neogen is something which looks attractive. Rosari Biotech, on the other hand, I think looks to be more of a short covering candidate only.
Okay, let's welcome on board Deepak Shenoy as well and find out what he's making of the market right now. Deepak, hi, afternoon. Want to discuss IT first, considering soon we're going to be hitting the earnings with TCS and Infosys. Traditionally a muted quarter, but you think this muted performance or anticipation of a muted performance is in the price now?
Quite honestly, everything seems to be, the negatives seem to be in the price, Aisha. We're seeing the prices have come down quite a bit from where they were probably about nearly 1.5 years ago. So while IT was the best performing index in 2021, it's the worst performing in 2022 and now part of 2023 as well. The biggest thing is going to be commentary about whether they're seeing order flows start to re-begin or come back after a hiatus for about a year. Our belief is at least the visibility should be better. So some of the earnings of at least the larger cap companies should reflect, both the higher dollar rate based orders and also a relatively better margin profile than last year. I believe, of course, we'll know by Friday, so no point predicting too much. But I think at least the large caps, the commentary should be good. I think the mid caps will be hit a little more.
But hold that thought, Deepak. Let's go across to my colleague Sharad. He's standing by with an ET Now Insight as we kick off another earnings season, which is just around the corner, as you pointed out. Let's try and understand what is in store for the Q4 FY23. What are the valuations and EPS expectations really pricing in? Sharad, take it away.
Well, yes, the fourth quarter of FY23 would be in focus as the overall quarterly EPS for Nifty is expected to remain at elevated levels. And do remember, it's expected to come in at more than 220 rupees per share per mark. And the important thing is this entire inflation cooling off will actually boost the EPS numbers going ahead. But let's look at the hardline numbers. The number is 220 rupees per share with almost an implied growth of 3% if you compare it with the Q3 numbers. Now going ahead also for the first quarter FY24 also is expected to rise as high as 9%. So that is something which you'll be watching out for, and of course the EPS growth is on an upward trajectory. Apart from that, which are the important stocks over the next 3 months itself will have the highest EPS growth? And of course, to making in the list in this Nifty, space is Kotak Mahindra Bank with almost 18% growth, and also this applies for UPL and Coal India. This is closely followed by ONGC and SBI as well. But apart from this, if you just look at how the performance has been over the Nifty earnings over the last 5 quarters, we see the above numbers which have come in have actually come down below 20 companies in the last quarter which had reported. But do remember, the inline set of numbers have been reported, and that this time in the third quarter itself, it has gone more than 50% of the total Nifty stocks. Now, looking at the important thing is the valuations part, and over here we see for FY23 it's almost at 18.5 times, but going ahead is expected to go to almost 17 times in the next 2 years. Apart from the valuations, the EPS is actually in focus, and do remember when the year had started FY23, it was around 837 rupees. It went up to almost 847 rupees after the fourth quarter of FY22, but currently as on 31st March, it stands at 830 rupees per share.
Okay, Sharad, thank you so much for joining us with all that update. But the expectations from the real estate pack for earnings are also quite ripe, given the fact that the operational updates have been quite strong. Deepak, what's your sense with respect to the real estate names? Any favorites?
Nothing yet. We believe here that the real estate will, the high right now seems to be, will be temporary, at least both in sales and in the company prices, because of increasing interest rates, which will hurt them and their customers in the days to come. So we're not very confident that real estate will sustain. From a investment perspective into the companies that make real estate, they never seem to make money no matter what happens. If the market prices of flats go up, they don't tend to make money, and when times are not good, also they don't take to make money. So I'm a little skeptical about the sector's performance in general. So happy to be corrected on the results, but right now I'll stay away.
Ancillaries though, Deepak, because the kind of buoyancy that you're seeing in not just tier 1 but 2 and 3 cities as well, that can't be ignored. You've got to participate somehow. So are you looking at the ancillaries at all?
Yeah, I think there'll be some parts of real estate that will, so for instance, you could do cement, steel, interiors, the Kajarias, the Serras, those, I think they will continue to have robust performance, but they're relatively more, companies that are less, exposed to interest rate based fluctuations. Real estate as a direct real estate developer has much more of issues with respect to real estate and cost of funds. What happens in real estate to the real estate developers is anytime they make money, they go and buy empty land somewhere else at relatively elevated prices, and the ROEs therefore are not very satisfactory because they end up keeping those lands idle for a really long time. Whereas the ancillaries don't do such things. So you get much better ROEs there. So yes, ancillaries definitely, I think those would be an anytime kind of purchase regardless of a real estate cycle.
So ancillaries are perhaps a better way to play that real estate boom as well. But let's talk about some of the fintech names, because while Zomato, etc. had been sideways for a while, there seems to be some sort of momentum, at least today, on the likes of delivery, etc. Let's listen into the views coming in from Sameer Arora on the fintechs.
We have two names in these 25 names, which are Paytm and Zomato. Paytm, of course, we have got good timing, so we are up some 20-25%. Zomato, we were up and then it went back, so now we are zero. But both these are big brands, big survivors. And although, like for example, you read recently that Reliance is coming into cosmetics or trying to compete with Nykaa and stuff like that, nobody is going to announce, new person is going to say that we are going into food delivery or going into even payment business so easily. And therefore these guys are now in a place where previously there may have been 20 guys and now they are, in the case of food delivery, down to 2, and there is no way a third guy can come in. And in this, one of the two is unlisted, and if they compete too hard and think that by getting a few more market share points here or there, they can have a hope of getting listed, that also does not work unless Zomato does well. So I think that the steady state solution will be that Swiggy will back off, let the Zomato win a little bit in the market so that some years or months later, maybe 1 year later, it can hope to go public. Otherwise, it can keep fighting without having ability to get listed, because the market will not accept a second name in exactly the same business with nearly exactly the same market share.
Okay, that's Samir Arora talking about what he's making of Zomato as well as Paytm. But India has denied UK media reports on the India-UK trade talks being suspended, calling the reports as completely baseless. Earlier, remember, UK media had reported that India had halted trade talks with the United Kingdom and will not restart them till the latter publicly condemns a Sikh extremist group which attacked the Indian Embassy building in London in the month of March. In fact, we have with us Srinjoy joining in to give us details on the same. Srinjoy?
The Indian government making it very clear that talks on trade with the United Kingdom will continue. There will be no break. Yes, India is not happy about what the Khalistanis have done in London, in Britain, and so on. But the trade talks have not been called off. The Indian government sources are making it very clear that all reports about India breaking off ties, trade talks with Britain is baseless.
Okay, one of the top gainers at the index level is also ONGC, 4.5% higher on account of the, Kirit Parekh recommendations being accepted by the cabinet now. But Deepak, would you look at the oil and gas space for serious investment, even the CGD space, because it continues to be very volatile, especially on account of the policy changes. How should one approach this?
A good question. We actually haven't. There's so much policy mired in all of this that we're concerned in general about, especially getting into CGD right now because of the policy, which recommendation is going to eventually take over. I haven't seen any of the recent news on it, but we're like, let it settle. But we do have some investment in Reliance, so a little bias there. I think, crude prices being where they are, and the corrective influence of both the US having relatively lowered stockpiles and not refueling them, and a little bit of a desperate action by the OPEC to try and curb production at this time. I don't think we're going to see much more highs in crude prices in the near future. So therefore, at this point, the fundamental basis beyond policy is not very strong for like a company like an ONGC. Of course, it's relatively underpriced in general, just being a PSU with relatively good cash flow. So I would say, a re-rating at some point might happen in general. But right now, we're not keen on something like ONGC. I'm more keen on something like Reliance because of the ancillary other parts of the business that Reliance has alongside.
Makes sense. Okay, that's the take coming in. In fact, we also spoke with Kirit Parekh himself to understand what is going to be the impact of this new pricing for final consumers as of today. Here's what he told us.
See, the one is to recognize that currently large amount of LPG is imported. So if the LPG price goes up, then the consumers have to pay a higher price. Now, what we have done, the consumer price would remain lower than that LPG price. CNG price would be less than that. So if you, for example, if you're cooking with LPG cylinders and if you change over to piped natural gas, you will find that your monthly bill is lower than what it was otherwise earlier with LPG. And the same way would be applied to the CNG users' vehicles. If, for example, even if you are driving a diesel vehicle with a Bharat Standard 6 emission controls, BS6 emission controls, your emissions of CO2 and particulates both would be higher than that of a vehicle which is using compressed natural gas. So it is a desirable use because it will reduce urban air pollution or indoor air pollution in kitchens. And that's why I think in both the cases, the price range is such that it will always be less than the competing fuels that are available.
Right, that's the take coming in from Mr. Kirit Parekh himself. In the meantime, Deepak, you were talking about as to how Reliance's business and the next set of triggers is going to come from outside the E&P business. Highlight that for us because lots is happening in retail even as we speak.
Yes, I mean, actually, Reliance is, there's so many parts of the business that seem to be firing, on in different fronts. So, for instance, you've got the retail part. They have recently had a slew of acquisitions in the fashion space. They've added Campa Cola, and I thought they'll be advertising it like crazy in the IPL. They haven't been, or at least I haven't seen that much, but. There is that as well that is coming in from the retail front. On Geo, I think the acquisition numbers, we're seeing Vodafone lose more and more in terms of subscribers. Geo will probably get more as a result of the IPL and part of some of their new plans that they're coming up with, what they're doing with 5G and the phones coming later this year. That there's this potential move there. There is the financial services demerger, which unlocks roughly 85,000 crores of value over the next 4 or 5 years into a subsidiary which all current shareholders of Reliance will get as part of their ownership. So that is another part, that's an unexpected part of that business. And I think apart from that, you've got the oil and gas, the petrochem business, refining and petchem business, which I think is relatively very, very strong compared to any other player in competition in India. So you've got fairly good cash flows. Their ROEs are nothing to write home about right now. And I think a demerger, whenever it happens, will be the one that will kind of trigger a re-rating in the stock price. But earnings this quarter should be very interesting. Hopefully, better earnings from their oil and gas business and much more from the retail and Geo business as well, all adding up to where the current PE is now 22 or 23 times historical, and I believe if they get their earnings right, it might fall below 20 as well. So we're invested, so quite honestly very biased here.
What is your take regarding some of these pharma names? And a lot of pockets are actually doing well today. Max Healthcare on account of that Motilal initiation, Medanta, then you have Jubilant Ingrevia, Jubilant Life, PNG Health, the likes of Aarti Drugs. They're all trading with gains of anywhere between 4 to 10%. How are you looking at playing the pharma theme, Naresh?
So in pharma, say there are two stocks which have clearly taken leadership. One is Dr. Reddy's hit a new 52-week high. Good momentum from 4550, 4600 has slowly moved up to 4750. So that is one. Second is Sun Pharma, which is trying to hold above the recent base as well as setting up for a move into new 52-week highs. And these are the two heavyweights in the pharma index as well. Then second is to go in the small cap names wherein there are bounce back trades. So something like a DV's Labs which could bounce back, a Laurus Labs which has corrected 50-60% from the top can bounce back. But those are trades where one has to keep a strict stop loss given that the overall longer term trend is still bearish. But in terms of hiding, the good places are Dr. Reddy's and Sun Pharma. So that is what I would be focusing on, and a little lesser allocation to the smaller and mid cap names in the pharma pack.
Some of these cement names are also trading close to the 52-week highs, Kunal. Ultratech Cement, Dalmia Bharat. Any names from the cement pack that you like?
Ultratech is something which I've been bullish on, and that's a stock which I would continue to be focusing on the buy side. I think the stock has confirmed a very strong breakout, and I think the breakout goes back maybe a couple of months for Ultratech Cement. That was a point of time for the markets where there was heightened amount of volatility, uncertainty, and the markets were going through a downward trend for themselves. Now in this phase of recovery, of course, most of the sectors have made a comeback, but the ones which have been more formidable, even in the last 3-4 months of the downtrend, was the cement stocks, and Ultratech Cement was one of the formidable names in that pack. So would be bullish on Ultratech Cement. My recent targets which I've allocated for the stock is close to 7,875, 7,900 range for the stock. So would expect at least another 200 point up move for the stock over the very near term.
Okay, that's the take coming in on Ultratech Cement. Just looking at a couple of other buzzers. PFC REC are also seeing quite the breakout as we speak right now. REC holding up 4.25%, and that's pretty much the move with PFC, if not more. 6.25% move coming in on that stock too. Adani Enterprises, Power Grid, Adani Ports, L&T, which is by the way now hit a 52-week high. There's Wipro as well as Grasim, which are all looking quite smart. Titan as well came out with its Q4 updates and very strong commentary coming in. Not just that they anticipate a 23% revenue growth for the jewelry business on a year-on-year basis, but the fact that the non-jewelry segment as well has done pretty well. Deepak, what is it that you're hoping to hear from these niche consumption plays once the earnings are out?
I think consumption from a durable sector, we have not seen anything positive for the last few quarters. So hopefully something positive comes out in terms of trends. We're seeing jewelry, of course. Jewelry, I think the gold price increase has a lot to do with it. So there is a rush towards more jewelry in general. So I think the jewelry players will do well. There is white goods. We're seeing some movement. Typical of this time, you will find the ACs and some of the durable makers kind of respond. But again, it's usually a 1 quarter phenomenon, and then prices go, sales go back down later. So that's one part. And then the staples. There, I feel margins will compress. So whether it is the FMCG pack companies, we're going to see margins compress across the board in many of those companies where the P ratios currently are very, very high. So you end up with you can't value those companies today at these interest rates at the same level as we did, even though they don't grow anywhere more than 10 to 12%. So I don't expect too much of growth from the staples packs and margins to compress. Durables, I'm waiting for commentary. I think it will be positive, but let's wait and see. Always been surprised in these cases.
Yeah, sure enough. L&T though, Kunal, managed to clock the 52-week high.
Yeah, Isha. So I think looks attractive.
Sorry, what's on the charts next?
So again, I think it's again a statement that the stock takes a lot of time for a pause in between before it manages to channel itself towards a new high. And we've seen that phenomena for L&T. So I think the last time when the stock was at a new high or a fresh 52-week high was in the month of January or the first half of the month of Jan. And then for the last two and a half odd months, the stock went into a consolidation, traded in a band of I think 150, 200 points for itself, and then managed to break out yet again. So I believe that this could probably propel the stock higher to maybe 2,400 kind of a zone. But I think again at those levels we can expect the stock to consolidate a bit more. So a classical sign of a step function for stock price where it moves up higher, consolidates, and then moves up into a higher trading band for itself. I think broadly the support for L&T is now at 2,200 levels. So closer to 2,400 mark is where we would look to book out profits, and then in case if the stock dips back again to 2,200, 2,250 mark, that's a zone where we will look to buy back.
Okay, time to now get the BDSC ideas also out of the way. Naresh, you go first. What's on the BDSC radar? Naresh?
That would be a buy on Indian hotels first. The stock has come very close to that breakout point of 330, 32 today. A risk to our trade here, a stop loss at 325 and a target price of 340. Second is a buy on Tata Chemicals, which has seen some price volume action over the last 1 hour. Could see a follow up towards 1030 tomorrow, stop loss at 989.
BTST trades?
So I'll go with one buy and one sell. The first one is a buy on Tata Chemicals. Looks attractive for a short-term breakout. 1035 is the target, flagged off in the morning as well. Stop loss at 980. And the second would be a sell on a HDFC Limited. Now, stock has done exceptionally well in the last 3 or 4 days, but somehow the indicators are coming into an overbought territory. So a sell, targets of 2675, stop loss at 2750.
Okay, let me also flag out some of the events which are lined up for tomorrow. The China CPI and PPI data will be out. So in the morning, we'll be watching out for that. And in the evening, IMF World Economic Outlook forecast is expected. So any change, any trimmings, any upgrades is something that we'll watch out for. In terms of the earnings, Delta Corp is expected to report numbers tomorrow. Remains quite a bit of trader favorite. So let's see what kind of moves do we see on that one ahead of that. And then in terms of other corporate action, Varun Beverages, wherein tomorrow will be the last date to be eligible for dividends. So some of these counters are what we are watching out for. But before we start wrapping up the day's trading action, Deepak, your take as far as the private financials are concerned, do you believe the likes of ICICI, HDFC Bank, these are the best ways still to play the banking sector, or now the party is really in the mid-cap and the small-cap banking names?
To be honest, I think the large caps still have it. We own some of the large cap banks, so bias there. But the cost of higher interest and the way we're seeing some of the private banks increase deposit rates in this environment, increase even savings bank deposit rates, I feel that the smaller banks will have much more trouble maintaining margins, showing higher ROE. And of course, RBI has increased the housing loan weights starting April 1st this year. So they had given a concession during COVID. So banks are going to struggle with the housing loan expansions as well in terms of showing ROE and growth. So I will, still bet on the larger banks. They have a more diversified balance sheet.
Right, okay. Deepak, good to have you in the show as always. We'll let you go on that note. Let's begin winding up for the day. 17,685 is where we're shutting shop for the future. So yes, giving up those session highs, while realty, power, technology have all stood to be sectoral winners. Automobiles, infrastructure and metals as well to some degree. That was not quite the story with banks, but telecoms, or for that matter, FMCG. Let's first understand or rather address the weak link in the market, and that was clearly bank. Be it an IDFC First, be it an HDFC Bank, IndusInd, ICICI, Axis, SBI, they all have managed a red close for themselves. But yes, many gainers as well. Pick up the realty pack and everything from a DLF to a Godrej Properties to an Godrej Realty. They were all holding a buzz in trade after excellent reportage on the Q4 updates from both Godrej Properties as well as from Sobha Developers. So all those stocks holding a buzz. Tata Motors as well, the JLR Q4 update looks strong, 5.6% higher is where the Tata Motors futures closed in for the day. ONGC with a 4% gain, Adani Enterprises, Adani Ports, L&T, TechM along with Wipro, they've all managed a firm close for themselves. In fact, that's pretty much the case for the rest of the IT packs too. So HCL and TCS as well were winners along with Infosys. But yes, Bajaj Finance, Unilever, Nestle, ICICI Bank, Asian Paints, that segment of the market is where you saw profit taking along with IndusInd Bank as well. The breadth of the market is smidge higher as compared to what the declines had in store for us. So while IDFC, Petronet, IDFC First, Idea and Havells were laggards, on the flip side, like we said, Godrej Properties, DLF, PFC, REC, these were some of the names which managed to hold a buzz in the session. Also, you saw some OI build up for names like a Voltas, for ONGC, Tata Motors quite significant as well, 16% OI build up, and then Gujarat Gas as well, wherein you did see some OI gains building for themselves. But that's pretty much it. That's how the market has panned out. Kunal, just a quick take on where you think the Nifty is headed next. Some more consolidation, you think?
Yeah, some more pause, some more consolidation, and I think it could be healthy in nature for the markets, because the more we consolidate at a higher level, the more the chances that the markets are getting ready for a breakout back again. So maybe a couple of days of pause, mild correction of 50-100 points on the indices, but broadly that could be termed healthy in nature.
Okay, so on that note, we'll thank Naresh and Kunal for being with us and helping us go through this Monday morning. But that's it. We're wrapping up this edition of Closing Trades. See you tomorrow.